Hello and a very warm welcome to this Scope Ratings webinar, Borkum Riffgrund 2, Rating, Rationale and Drivers. My name is Keith Mullin. It is my pleasure to be your moderator for today's session. Now, as you may be aware, Scope assigned a first-time public rating on the 7th of February to the 815 million euros of senior secured notes issued by Borkum Riffgrund 2 Investor Holding GmbH. As additional market outreach, we felt it would be helpful to explain the rating rationale in this context for this German offshore wind farm and outline key project risks and rating drivers in the context of Scope's expected loss methodology. Now, to do that, I'm delighted to be joined today by Torsten Schellscheidt and Konrad from Scope's project finance team, who in a second will take you through a presentation. Now, once they finish, we'll be happy to take your questions. You can type these into the webinar platform using the questions function as we go along. And please note that the presentation today's presentation will be available for download during the session. So that's it from me. Torsten and Aaron, it's great to see you. Torsten, I believe you're going to kick us off, so the floor is yours.
Yeah, thank you very much, Keith. And also a warm welcome from my side. With regard to this transaction, let's jump maybe into the topic. Please be aware that we have rated here the notes of Borkum Riffgrund 2 Investor Holding GmbH. The 0.2% expected loss we have determined for this transaction are meant over the whole lifetime of the financial instrument. And it is an expected loss rating. This is important to mention. The key drivers of this transactions and our transaction and our risk analysis you will find on this cover page you see here. We also are summarizing the key information on 5 risk areas here at the bottom. And these 5 risk areas are more or less the base of our analytical framework. So we are talking, for example, about technology and construction risk in the first risk area, which, by the way, is a condition precedence to get to the other risk areas, which are operational risk, revenue risk, financial strength, and project structure and other risk. So this is our basic framework we do analysis on, and you will find, the summary on the first page. When we look, for example, at construction risk, and this is also taken here from the first page of the rating report, of course, Borkum Riffgrund 2 was already up and running since 2019. So all risk contributions coming from the construction risk area were more or less zero. So you see here an RF standing for risk-free. Coming to operational risk, we of course need to acknowledge that this is an offshore wind farm operating in a harsh sea environment. So you see that the risk contributions are a bit higher, so 40% coming from the operational risk area. On the other end, we found sound mitigants here. So the project is really in a good position to manage those operational risks. Only to mention a few mitigants here. We have quite experienced service providers. One of them is Ørsted, for example. Ørsted is operating and maintaining the wind farm for 20 years. We also have Vestas on board. So Vestas is providing services for the wind turbine generator within the first 5 years. They are also providing a production-based availability guarantee. And above all, we have, when you look at the contractual framework, we have a largely fixed fee OEM contract with Ørsted. And we have also a maintenance reserve account at the issuer level available. So you see that we really have a lot of strong mitigants to compensate from the operational risk. Coming to the next risk area, which is called revenue risk, you see that the expected loss contributions here are not so dominant. So we have like 20% here. Of course, the project benefits from stable and predictable revenues. And the reason is, of course, that we have no price risk in this transaction. We also have low volume risk because offshore wind is, from the volatility point of view, comparatively low. Coming to financial strength risk, this is 28%. Maybe this was one of the weaker spots in this transaction. So coverage ratios were only average in this transaction. Nevertheless, we had also some important mitigants here. The project demonstrated a really good resilience to cash flow stresses. We also had refinancing risk in this transaction, which was in the end low, because the balloon is about 100 million, is relatively small. So compared to the overall notional, it was 12%, or it is 12%. We have a balloon reserve account in place. So this is to be filled 3 years ahead of maturity. This is also a plus, especially combined with the mandatory cash sweeps, which are provided then in this time frame. We also have, and this is quite positive, at least 15 years of useful economic life after majority. And we also benefit from a regulated floor price mechanism for at least 10 years after maturity of the notes. So all of these mitigants are a strong plus with regard to the financial strength assessment. Coming to the large risk area, which is called project structure and other risk, here we have a specific feature, which is a potential threat that the note holders may be structurally subordinated to an unforeseen emergency funding from Ørsted. This can happen. For example, if the issuer, so Borkum Riffgrund 2 Investor Holding GmbH, is unable or unwilling to fund critical works which are necessary to maintain or to restore the offshore wind operations. So this is at first sight a disadvantage. When we think about the likelihood of this kind of event, we thought there are important mitigants we scored quite positively because the offshore wind farm already showed a good operating performance to date. That's an important mitigant, as well as the experience of the involved sponsors and operators, which both have a significant interest in the project, also made us comfortable that the likelihood of seeing such a unforeseen subordination is quite low. This is with regard to the likelihood. We always look at this as the benefit of our approach in terms of expected loss as the corresponding severity. So you might ask, okay, I mean, even if the likelihood is quite low, what would it mean, in terms of severity if we have such a scenario? Also here, we check this, of course, we have contractual caps on servicing such loans in place. So on the severity side, we are also quite comfortable and didn't deduct this or see it as an extraordinarily high risk. So this is a short summary of our assessments of the 5 risk areas. You see also here this pie chart, quite transparent, explaining to you what the main drivers are in terms of risk, from what risk areas they're coming from. What we also offer is in our rating reports or with our methodology, we have alternative risk indicators in place, which we call expected loss strength. So this is EL strength and PD strength, probability of default strength. So what is that? Basically, it is an assessment of the relative riskiness of each risk area. And this is not a rating, of course, because you notice that we are using lowercase symbols here. It's just a conditional risk assessment. And what you also may have noticed is that the expected loss strength is often stronger than the PD strength. And the reason for that is, of course, that we somehow analyze severity. And in the case of Borkum Riffgrund 2, the severity or the quality of security was good enough to mitigate probability of default risk. So you can see it also as an uplift to our PD assessment. And this is also quite transparently shown in the report. And we can even go into even more detail with regard to credit impairment events. This is the next page. credit impairment events are linked to those risk areas. You also see here the scoring of Borkum Riffgrund 2. You see that construction credit impairment events, so potential scenarios that may lead to a loss for investors, which are linked to the construction risk area, they have been scored 0, so no risk at all. Not surprisingly, because we are not exposed to construction risk. The other credit impairment events you see are some more or less distributed, between double B and double A. And you see quite nicely here what the weakness or the weaker spots of this transaction the weaker spot of this transaction is, and what kind of uplift we had from severity considerations. And by the way, the blue colored credit impairment events, these credit impairment events are the most risky ones, which we have identified during our analysis. So this is a quite powerful framework, I would say, because you could, for example, use this kind of charts, to make quite transparent what the relative strengths and weaknesses are and what kind of drivers we have in certain transactions. You see here, Borkum Riffgrund 2, we're scoring with regard to expected loss contributions. This pie chart here we have seen before. We have also seen the relative riskiness of each risk area with regard to expected loss strengths and probability of default strengths. Now you can just compare it, for example, with another transaction. This is I took here HOSC Albatros. And you see directly where the differences are coming from and what is driving risk. For example, from HOSC Albatros, we had a small exposure to construction risk. So construction risk contributions in terms of expected loss also played a role, so accounted for 2.4%. This is quite low because, this offshore wind farm was already largely operating when we had looked at it. What you also can spot here is the difference between PD strengths and expected loss strengths. Both offshore wind farms are, of course, in more or less the same environment. So we are in Germany, German regulation, offshore wind, and you would expect from a PD perspective that we have, identified quite similar scorings. This is exactly the case. But if you look, for example, at the expected loss strengths, you will notice that, the difference between expected loss strengths and PD strengths here is smaller compared to Borkum Riffgrund 2. And this is exactly, due to the quality of the security, which is better in the case of Borkum Riffgrund 2. Why is this? With HOSC Albatros, we have the situation that lenders, for example, were facing a double minority position. For that reason, even, if this scenario is quite low, we would face maybe a project sale, a double minority position is definitely a disadvantage, and we have currently scored it more negatively in the case of HOSC. So this is quite nice if you compare those charts across sectors or even across different asset classes. You can do it even more detailed if you look at the individual credit impairment events, and you see also quite nicely that the risk from a PD point of view is quite the same. Of course, we are talking about similar assets, but the severity considerations are quite different. The upward notching, we do not a notching, but you see the expected loss strength is here 1 to 2 notch better than, for example, in the case of HOSC Albatros. Okay, I already have mentioned the basic framework. I mentioned at the beginning that our framework rests on 5 risk areas and 16 credit impairment events. These are shown here on the right-hand side. These 16 credit impairment events are quite generic, so they are always the same, but the scoring is of course different. And yeah, the base for our methodology is that we have decomposed project risk in those 16 credit impairment events. And of course, they are linked, and I mentioned that in the beginning, to the 5 risk areas. So therefore, you see, the 5 risk areas, the summary of those estimates or assessments on the front page, and they are linked to the 16 credit impairment events, which in the end, are driving the overall project risk. And our task is for each rating to score those credit impairment events, which again, are scenarios that can lead to a loss for the investor, that we need to score these scenarios in terms of likelihood of occurrence. You could say maybe a PD equivalent and severity. And this is, the overall task we need to do. And in the case of Borkum Riffgrund 2, if we have performed our analysis, so we have determined, and this chart is taken from page 5 of the rating report, we have determined the likelihood you see here for each credit impairment event, and also the corresponding severity here. And you see how we get to our expected loss contributions from each credit impairment event. And you also see, of course, that construction risk in the case of Borkum Riffgrund didn't play any role. So we had no expected loss contributions coming from here. You see that we also mentioned here in this tree the relative riskiness of each credit impairment event. Therefore, you have information on PD strengths and expected loss strengths. And the same is true, of course, with regard to the 5 risk areas. Okay. So you might now ask, okay, how did we get to all these numbers? Basically, we need to do two things. We need first to assign a probability, likelihood of occurrence of each credit impairment event. How do we do this? Basically, we have a scoring model for that, which consists of 23 risk factors. These 23 risk factors are the base for our assessment. And you see here this chart is coming from the Borkum Riffgrund 2 report, that the revenue risk area, for example, has been assigned 5 risk factors, which we score from very low to very high. So this is the basic scoring framework from us. And to determine those scores, we also have published guidelines so how we see certain risk and how we would score them. You will find them on the internet and also in our methodology if you have questions here. With regard to Borkum Riffgrund 2, for example, we have scored revenue contract risk very low, quite easy. We have no price risk here in this transaction. So, I mean, there is no risk, coming from the revenue contract side. Economic fundamentals, on the other hand, was only scored average. The reasoning behind that is that we have, of course, a significant dependence on subsidies. So for that reason, we score this average. The volume risk, you might ask, in offshore wind is low. Therefore, we're talking about reserve risk here. So the volatility of the wind yield is comparatively low because we have high average wind speeds compared, for example, to onshore wind, which would score more average here. On the other hand, we have lower volatilities with, for example, with solar farms, which would score here very low. So this is, the way we score this kind of risk contribution here. And please keep in mind, we are only talking about probabilities here. So the likelihood of seeing certain restructuring events. Supplier risk didn't play a role at all here. I mean, this is maybe more valid for biogas projects, for example, where we have, a big reliance on feedstock. Off-taker risk here was more, related to the direct market agreement with Ørsted Cycle and Service. We had a credit rating out there, official one, but it's not only about credit quality. We also have to check, okay, how easily can this counterparty be replaced? Are there other alternatives in the market? So all these risk considerations we assess in our guidelines. And for that reason, overall, the scoring in the case of Borkum Riffgrund was made low here. Yeah, And this exercise basically we're doing for each risk area. So we have only looked at the revenue risk area here with 5 risk factors, and we have 23, and they all relate to different risk areas. And if we have finalized the scoring, we then have to look at the losses. This is quite special, I think, in our methodology, because you really need to think about what can happen in what kind of restructuring scenario. So it's really sometimes a challenge and quite interesting. Basically, we have 2 frameworks here to do this. One is called the specific recovery framework. And this framework we apply only to the top 3 credit impairment events. And when I say top 3, I mean the top 3 in terms of riskiness. And this is basically the outcome of our analysis. So we apply the specific recovery framework to the top 3 credit impairment events, so the top risky ones. And for that, we use the project's financial model, to calculate in the end recoveries. For the other 13 credit impairment events, so for the top 3, we are doing this. For the other 13 credit impairment events, we're using a standard recovery framework. So basically, what is that? I mean, we have developed different recovery distributions like that for each credit impairment event. And the shape of those distributions and the expected recovery coming out of that depend on the nature of the credit impairment event, of course, because in construction, for example, you are facing, you will be faced with a much higher likelihood to see higher losses as opposed to the operational phase. So for that reason, the nature of the credit impairment is really important. Also, the type of the underlying asset plays a role. And also things like the financial structure of each transaction or other security features. These are also important considerations we determining the shape and the expected recovery in the end. In the case of Borkum Riffgrund 2, it looks like that. We have determined here the top 3 credit impairment events. And if you remember, I described, okay, we do that based on the project's financial model. So this is a quite creative approach. We try to trigger potential restructuring events. And you see here 2 out of 3. What does this mean? Basically, what we are looking for is, we have identified that the most risky credit impairment events, and we try to figure out, okay, what can happen to trigger a potential restructuring. And in the case of the first, credit impairment event, which is called here revenue deterioration, what have we done is we have assumed that we have technical issues, technical difficulties with the wind turbines, for example. We have assumed lower wind yields, and all of that, somehow impacting our cash flow stream and triggering a restructuring in the end. And you see that in terms of assumptions, you will find this in the rating report, but to reduce wind yield, for example, we have assumed P99 production, and we also have assumed 50% lower availability rates for the turbines after Vestas, is out of the contract, and this triggered the restructuring in the year 2024. And to see how we simulated a potential restructuring scenario, making assumption about cash flows to senior lenders, maybe new senior lenders after a project sale, or to sponsors. These kind of things and the underlying assumptions are described in the methodology, because the calculation is, of course, based on an MPV approach. So we need to specify cost of debt, cost of equity, the financial structure, restructuring costs. So we need really to do all these assumptions after a restructuring. So this is the way how we constructed the revenue deterioration top 1 credit impairment event. And yeah, quite similar things we did for the debt repayment or cash flow liquidity issues. This was the second credit impairment event, the second of the top 3 credit impairment events. Here we went one step further. We assumed a replacement of the OEM provider because it failed to provide, the turbine availability, and in the end went bust or was not available anymore. So we need to replace them, and of course also make assumptions about OEM costs then going forward. And to see that this restructuring scenario started a bit later here in 2025, 26, and how the cash flows look like you also can find here in this graph. So if we have done this for all the top 3 credit impairment events, we have determined in the end, recoveries for 3 out of 16 credit impairment events, but we now need to look at the other 13. And how do we do this? Basically, for this purpose, we use 2 sets of recovery curves, depending on the stress resilience of the underlying asset. So we either assign a high or low stress value resilience. What does that mean? Basically, we decide for the shape of the curve. You see here that if you look at the project level recovery here, and if we just assume for the moment that the 40% here describes the project level recovery of 40% or less, and the corresponding likelihood is 30%. In this example, when we use this kind of recovery curve. Opposed to the left-hand situation where we have a completely different shape of the curve, and you see that when we also assume project level recoveries of 40% or less, this likelihood is much smaller, 1/3 of this likelihood. So this kind of shape is meant for more defensive assets like PPP projects, availability projects, for example. And in the case of Borkum Riffgrund, we decided for the lower stress value resilience because we are in the rough environment in the North Sea. We have only a limited economic life, less than 25 years at the moment. We also are partially exposed to merchant risk following the initial FIT period, and we are also partially exposed to higher maintenance risk in the later stages of operations. So for that reasons, we have assumed for this project a lower asset value resilience, which uses a higher likelihood for higher losses in the end. You can see this also in the rating report, how the shape of our recovery curves for Borkum Riffgrund 2 looked like. You see what I have mentioned before, that we have different shapes here for each credit impairment event. I mean, this is just a selection here. And this is, of course, due to the fact that, the credit impairment events are quite different in terms of what type of losses can occur. And we also have other factors which determine the shape of the curve. I mentioned them already. They have to do with the type of the asset. We have looked at it before. So stress value resilience. Also the financial structure of the transaction plays a role and determine the shape of the curve. We also adjust the expected value coming out of those curves. I mean, for example, with specific security features. One example is termination compensation. So these kind of things are also recognized, and you will find the shape of the curve which we use for Borkum Riffgrund 2 in the rating report. So if we have determined all the losses, I mean, in each of the credit impairment events, we are almost done. We have assigned the probabilities with the scoring model. Remember the scoring between very low to very high. We have assigned the losses for the top 3 credit impairment events on the project's financial model, and for the other 13 with the standard framework. And if we have done all of that, we again, are at our probability tree, where you see, the likelihoods we have been assigning to the credit impairment events, the severity, expected loss contribution, and also, other risk metrics like the PD strengths and expected loss strengths, information about that. And in the end, all expected loss contributions determine the total expected loss. In the case of Borkum Riffgrund 2, we calculated 0.2%, and for the full project. And this corresponds to the expected risk horizon of the financial instrument, which is more or less the duration. Its duration, assuming a zero discount rate. We need this information to determine the rating in the end, because the 0.2% need to be set into context to the expected risk horizon, so the duration of the financial instrument, which can of course deviate. And in this case, we had, and you will find this information also on the first page, we had an expected risk horizon of 3.67 years for the notes of Borkum issued by Borkum Riffgrund 2. And also corresponding to the expected loss gives us an A minus against our idealized expected loss curves. So this is how we determined the rating on the notes issued by Borkum Riffgrund 2. I think we are now able to address your questions.
Very good. Thank you very much for that informative and detailed presentation, Torsten. Let's. So please, if you have any questions, please type them into the questions box, and we'll be happy to answer them. Actually, there is one question which I guess, Torsten, you kind of touched on as you went through, but perhaps you can just recap, or perhaps Aaron, I guess you go as the side who takes the question. But the question is this: how do you factor in the significant volatility in wind production observed on European offshore wind farms over the last few years?
Yes, basically, thank you for the question. I mean, basically, this we do, as I described here, and this reserve risk factors, but there are other ways to do it. I mean, I think you referred to in the last 3 years, we indeed had a bad performance, or at least not P90 performance in German offshore wind, for example. What we do is, we will recognize the operational performance of the wind farm in the operational risk area. This is to going back to the tree. This is then related to the operational risk area. This is one or two risk factors where we would be able to score the track record in the end. And you're right. I mean, for example, for Borkum Riffgrund 2, we scored it average, not only for that reason, because in the end, the offshore wind park here is quite productive and scores much better than other offshore wind parks, which maybe have a less pronounced productivity in terms of production. So Borkum Riffgrund 2 is not so impacted by this volatility. What we also do is, when we see that the track record is deviating from our rating case, and this is quite important, we would deduct, of course, something here. We have done this already, not in the case of Borkum Riffgrund 2, because we think that the track record is quite good so far. But we have done it in other scenarios where we had an offshore wind farm, missing P90 numbers for a number of years, and then we would deduct, for example, 5% from total production for the full lifetime for the wind farm, just to account for this bad performance or higher volatility. This is the way we would tackle this. And we also have the possibility, of course, to run, and this is the beauty of this framework, to run specific recovery scenarios. I mean, this could be also a revenue deterioration event, and you could just assume, and I assumed in Borkum Riffgrund, for example, as well, that we are only seeing P99 production, and you could adjust, with other factors as well, if you believe that we are even below P99 production.
Let me just add real quick to this, because it's an interesting question that's also interesting to discuss in front of our framework, which is a bit different from purely PD oriented approaches. Under an expected loss perspective, especially looking at the long-term expected loss over the entire lifetime of the instrument, you will see that in comparison with a pure PD angle, the question of volatility of a certain risk driver is, of course, a relevant question, but it will have less of an impact typically than under a pure PD perspective. And I believe this is quite intuitive, because if you're looking through a PD only lens, of course, if you have high volatility, the risk that you breach a certain threshold is high. But from an expected loss perspective, if you look over a longer time horizon, the value of the project will be less impacted by the likelihood of breaching certain thresholds in the short term. This is also true for other variables that are volatile, such as merchant risk. And of course, this assessment also depends on the risk horizon. So if say your instrument has a remaining expected risk horizon of, I don't know, 1 or 2 years, you will think harder about the volatility of these risk drivers, and if you don't have a meaningful revenue tail, for example. But thanks for the question, and yeah, back to you, Keith.
Yeah, thanks, Aaron. Again, there's a question which is a comparable question between two projects here. And the question is this: what's the key difference between the rating of Borkum Riffgrund and CPP-IB renewables?
Yes, thank you for your question. I mean, basically, we can look at the charts again, then it's maybe more clearer. The basic difference is that we are talking about a project which is not exposed to construction risk. You see here in the case of Jose Albatros, we had minor construction risk accounting for 2.4%, while at the Borkum Riffgrund 2 we had no construction risk at all. We also had some, we scored it a bit more riskier here at Jose Albatros in terms of likelihood due to the double minority position. And most importantly, the difference lies in the severity considerations. So the double minority position is, of course, a disadvantage when it comes to restructuring of the project, a project sale, for example, because we have no direct access to the asset. And for that reason, we have been discounting the recoveries coming out of our curves a bit. And this you can see here also in the distribution and the difference between expected loss strengths and PD strengths. So this is, I think, in absolute numbers, I think in Borkum Riffgrund 2, we are talking about recoveries on average, roughly about 80%. And Jose Albatros, I think, scored about 70 something. So this is the most important difference, the recovery, so the severity consideration.
Okay, thanks very much. We've got a couple of other questions here. There is one about actually emergency funding. And does this mean, can rated notes be subordinated to emergency funding?
Yes, exactly. I mean, this is exactly the problem. This is maybe a quite specific situation here. Yeah, they can be subordinated. We discussed, I mean, the likelihood on the one hand is quite low. We decided because of the track record, because of the experience of the providers and their economic interest. On the other hand, the question is really valid. Thank you for that. With regard to severity considerations, here we found that the risk is quite contained. So there is a cap, a contractual cap, 20 million per year. This is the maximum amount which is allowed for subordination in the end. And for safety, we also, of course, run a top credit impairment event for that to make sure that maybe to make transparent how the impact would be if such a emergency funding event occurs and what it would mean for the overall recovery. So, and in the end, I mean, it was not a problem. I think not only from the severity side, also from the PD view, because the 20 million per year is just enough not to trigger a restructuring event from a liquidity perspective. So you see, we are always talking about two sides of the coin here. So in the end, we found that neither from the PD side nor from the expected loss side, it triggered a significant risk.
Right. Okay, thanks. There's another question here, which is, I guess a quite a technical question, but it's about transmission. Now, is transmission relevant or important, and does it impact revenue? In other words, is there transmission loss?
Yeah, thank you for the question. Of course, it's important. I mean, how we do it, usually we have yield studies. We rely on yield studies and these kind of things. So potential losses, I mean, be it volatility or transmission losses, all these things are discussed in yield studies or technical due diligence reports. And yeah, we would rely on them, and yeah, we would somehow incorporate them, of course. And today we know that some issues maybe are not so discussed or have not so discussed in the past. Two examples: negative price risk, for example, was seen maybe not so relevant. Maybe in the last years, and also didn't pop up so in the real study. So this is something we always take into account in our rating cases. Also this blockage effects. This is really technical thing which the whole industry wasn't really aware of a couple of years ago. So these kind of things we also try to take into account. Now I think most DD reports also would account for that, but this was different a couple of years ago. That's true. So I mean, the technology is, although it's quite mature at the moment, there are still new situations or new insights where everybody learns, and we also try to be as early as possible to account for these kind of things upfront.
And just to add to what Torsten said, for brownfield projects like Borkum Riffgrund 2, we of course always have the assessment of the technical advisor, and we also have the historical track record. I believe for Borkum the transmission losses were in line with expectations, so immaterial. Torsten, please correct me if that's if that's untrue, but I believe that is the case. And if the historical performance shows any parameters deviate from what we expected, typically based on the technical assessment at project inception, then we might at any point in time incorporate these in our rating case assumptions, because our ratings are monitored on an ongoing basis. So as soon as we learn any material events, and notable transmission losses would be one of them, we will take action as appropriate.
Maybe it's one point to add here. Transmission maybe is a broad field, but with regard to Borkum Riffgrund 2, we have the advantage that we have a second link, so an interlink between the offshore converter stations. I think Dolphin Alpha and Gamma. I think I mentioned this also in the rating report. This is really positive when you think about outages, because you have a second link, you can export your power. And this was at least not always the case with other transactions and other wind farms. And they, of course, had a disadvantage when, if the link, transmission, if the link was not there for whatever reason, then the whole power was lost. And here you have at least the advantage that you have a second link. So even if one link, defaults, then you have a second one, which helps you to export your power.
Very good. Well, I have no more questions coming in at this point. And so if you have a last minute question, a very quick one, please ask it now. And as mentioned earlier, this presentation is downloadable, so you can do that now. I believe just if you hover near the top of the presentation, you should see a download button. So Torsten and Aaron, unless you have anything additional to add, I suggest we close the session. I'd like to thank you both for the presentation, and perhaps in particular to those of you who dialed in and listened. If you do have any follow-up questions, please feel free to contact us by email, and we'll be delighted to get back to you if you have any questions that occur to you perhaps after the presentation. So let's close the session. Wishing you all the very best for the rest of today and the week. Stay safe, and we do these sessions from time to time as appropriate. So looking forward to seeing you next time. Thanks a lot, and it's goodbye from us.
Thank you.
Thank you.
Bye-bye.
Have a nice day.
Have a nice week. Bye.